Okay, now before I go over page 5 of the comprehensive income, I just want to remind you again, I just finished with extraordinary gains and losses. I just want you to know that discontinued operations is going to be changing. How do I know this? Because I'm looking at a news release that was issued by the, news release means press release. The FASB issues a press release. It's dated September of 2008. And in their press release it says FASB proposes improvements to reporting of a discontinued operation, and they're amending the criteria for reporting a discontinued operation. So the 8 criteria that are found on page 130 in the middle of the page, guess what? That's going to be changing in 2009. How do I know? Because they already have an exposure draft, and they're requesting comments until January 23rd, 2009. As soon as they get the comments, then they're going to revise the standard, and they're going to issue it as an interpretation. So we're going to have a change to that. So anyway, you know, rely on us. We will keep you up. I keep up to date with all of this stuff. I will keep you up to date on anything that changes. So I just wanted to remind you that's changing. Everything's changing. Subsequent events is going to be changing. Earnings per share is going to be changing. Going concern is going to be changing. We already know how that business combinations and consolidations is going to be changing. It's just in it's constant flux. Everything that goes on. Okay. In terms of the comprehensive income, please turn to page 5 of your handout. And on page 5 of your handout, I talk about comprehensive income. Now, back in Module 7A, I talked to you about the Statement of Financial Accounting Concept. The Statement of Financial Accounting Concept definition of comprehensive income. But now I'm going to talk about Statement of Financial Accounting Standard definition, and this happens to be standard number 130. Okay, so Statement of Financial Accounting Standard number 130, which is a different definition. Recall that back in Module 7A, the definition under the concepts for comprehensive income was any change to stockholders' equity, or net, which is also known as net assets, any change to shareholders' equity which did not involve investments by owners or distributions to owners. But it's a different definition under Standard Number 130. Under Standard Number 130, comprehensive income consists of 2 things. It consists of net income plus other comprehensive income. Now, you know, I do not write these accounting standards, okay? So we have total comprehensive income. Now, this is the standard definition under Standard Number 130, consists of net income plus other comprehensive income. Of course, you know net income is net of tax effect, because you have income from continuing operations, that's net of tax effect, then discontinued operations, net of tax effect, then extraordinary gains and losses, net of tax effect, then finally you have net income. So all the tax has been taken out. Other comprehensive income is also shown net of tax. So that has to be net of tax effect. NOT stands for net of tax effect. Okay. Anyway, on my handout on page 5, it says note, Standard Number 130 was amended by Standard Number 158. Employers are accounting for defined benefit pension and other post-retirement plans. You don't have to worry because I updated this handout for it. Okay, SFAS definition. Remember, this is the SFAS definition under Standard Number 130. That's different from the SFAC definition. SFAS 130 definition of comprehensive income at the top of page 5 of your financial accounting and reporting handout is the total of net income and other comprehensive income. So comprehensive income consists of net income plus other comprehensive income. Okay, companies are now required to show comprehensive income. The standard allows them to choose one of 3 approaches in reporting comprehensive income, and they have asked what the 3 approaches are. The 3 approaches are approach number 2, first of all, and approach number 2, which happens to be the income statement that they put on page 128. Approach number 2 is to present a combined income statement, which is a statement of income and comprehensive income. That happens to be FASB prefers. The FASB loves this. Nobody does it, but the FASB loves it, okay? The reason why nobody does it is because if you look on your income statement on page 128, it's also approach number 2 on the handout for page 5. You have net income, and then you have a bunch of stuff after net income called the other comprehensive income, and then the net income plus the other comprehensive income items give you the total comprehensive income. Well, people get confused. They're like, what is profit here? I don't know what profit is. They can't find profit because there's just too much going on. So nobody uses it. The other approach that they can use, let's look at my handout, approach number 1, is to present a second income statement. FASB does prefer this. Nobody does it. Not that many companies do it. It's immediately after the income statement. You have a regular multiple step income statement, and then right after it, they do a comprehensive income statement. And from the comprehensive income statement, they start off with net income, which came from the multiple step income statement. They add the other comprehensive income items to give you the total comprehensive income. So that's the approach number 1 at the top of my handout on page 5, which is to present a second income statement. FASB prefers that too. Not that many people do it. Now, this is the approach that everybody does, which is approach number 3. Approach number 3 is to present comprehensive income and the statement of changes in shareholders' equity. This is what they do. Now, because this is what everybody does. That's because they bury comprehensive income and other comprehensive income items in a statement of changes in shareholders' equity, which nobody reads anyway. And FASB does not like this, but they allow it. And this is what everybody does. So approach 1 and approach 2 are preferred by FASB, but approach 3 is what is prevalent in the industry. That's what everybody does, to present comprehensive income and the statement of changes in shareholders' equity. And what I want to point out to you is that there's 2 columns, extra columns, in this statement. The extra columns are, on the left-hand side, the comprehensive income, sort of like in the middle, comprehensive income. Remember, the comprehensive income consists of the net income for $55,000, and then the other comprehensive income. The other comprehensive income items is the $15,000, which includes unrealized holding gains and losses, and you show that net of tax effect to give you total comprehensive income. So comprehensive income consists of net income plus your other comprehensive income items. And then other comprehensive income, which is a temporary account, gets closed into the permanent account. The permanent account for it is called accumulated other comprehensive income, which is on the far right-hand column of approach number 3. There's your accumulated other comprehensive income. The accumulated other comprehensive income is whatever was all your other comprehensive incomes from prior periods. The beginning balance is $30,000. You add your other comprehensive income items for this period to give you total accumulated other comprehensive income. Remember, other comprehensive income is a temporary account. It gets closed into accumulated other comprehensive income, which is the permanent account in shareholders' equity. Now, what are the examples of the other comprehensive income? And you have to be very, very careful on the exam. For one thing, they can ask you comprehensive income under the concept definition or comprehensive income under the standard definition. They're 2 different definitions. Remember, the concept definition is any changes to shareholders' equity which does not involve investments by owners or distributions to owners. That's their definition of comprehensive income. The standard number 130 definition of comprehensive income is net income plus other comprehensive income. So what are the other comprehensive income items? I have created a little list here for you at the bottom of page 5. It's a comprehensive list. I put it all in one place. They are, number 1, reclassification adjustments. Number 2, unrealized holding gain or loss on available for sale securities, as long as you do not elect the fair value option under standard number 159. That's why I say this assumes that fair value option under standard 159 is not used. If you elect the fair value option under standard number 159, the unrealized holding gains and losses on available for sale securities are part of income from continuing operations. Okay? If you do not elect the fair value option under standard number 159, it's still covered under standard number 115, and unrealized holding gain or losses on available for sale securities are part of other comprehensive income. Now, I just want to make a point of what is a reclassification adjustment. A reclassification adjustment is typically in a prior accounting period, you recognize some unrealized holding gain or loss on available for sale security, and in this accounting period, you actually sell that available for sale security. So let's just say that in 2008, I had an available for sale security that I purchased for 10. At the end of the year, so this was the cost. At the end of the year, the fair market value was 11. So I recorded an unrealized holding gain on my available for sale security as what? Okay. If this is an available for sale security for which I do not elect the fair value option, the unrealized holding gain or loss, in this case it's an unrealized holding gain of 1 because it went up in value by 1, that goes to other comprehensive income as long as I do not elect the fair value option under standard number 159 for this available for sale security. Then let's just say that in 2009, I sell it, and I sell it for 13. What I will have to do is take this unrealized gain, and I will have to reverse it, okay? So I will subtract that 1, and then I will record the realized gain, which would be 3, okay? And the difference would be from the 10 to the 13. That would be the 3 that I would record. The reason that I have to back out the 1 is because if I didn't back out the 1, this 1 is already part of shareholders' equity. If I didn't back out this 1 here, this goes to shareholders' equity. Even if it's other comprehensive income, it's still part of accumulated other comprehensive income, which is still part of shareholders' equity. If I didn't back that out, and then I didn't have this negative 1 here, then this 3 would go into a realized gain, then it would go into net income, go into retained earnings, and then that eventually would also end up in shareholders' equity. And I would have a 1 from 2008 and a 3 from 2009, both in shareholders' equity. So what I have to do is do a reclassification adjustment and back out the previously recognized unrealized holding gain or loss from my available for sale security. I have to back that out when I realize the actual gain or loss when I actually sell the item. Okay, so that's called a reclassification adjustment. Then item number 3 is standard number 158. These are specifically pension or other post-retirement benefits. I'm at the bottom of page 5 of my handout. Pensions or other post-retirement benefits adjustments under standard number 158 for gains and losses associated with pensions or other post-retirement benefits, prior service costs or credits associated with pension or other post-retirement benefits, and then item 3 little i's, transition assets or obligations associated with pension or other post-retirement benefits. So under standard number 158, there are a series of other comprehensive income items associated with pensions under standard number 158. Number 4 talks about unrealized holding gains or losses on derivatives if they're held as cash flow hedges. When you go over derivatives with me, which is in module 17, we will learn that there are 3 types of hedges. The 3 types of hedges are fair value hedges, cash flow hedges, and foreign currency hedges. The foreign currency hedges can be treated as a fair value hedge or a cash flow hedge. And we'll learn that cash flow hedges have unrealized holding gains and losses, and the unrealized holding gains and losses on cash flow hedges are treated as part of other comprehensive income, and they're reported net of tax effect. And then item number 5 is a cumulative foreign currency translation adjustment under the current rate method. You're probably going, oh my goodness. These are, we'll learn about that in foreign currency translation. Foreign currency translation is part of module 18E, when we do foreign currency translation there. Basically, when we convert over from a foreign currency into U.S. dollars, because of the conversion rates, our balance sheet may not necessarily balance, so you might have to plug a debit or credit to make a balance sheet balance, and that's called a cumulative translation adjustment. That also is considered to be an other comprehensive income item, okay? And it's only under the current rate method. The remeasurement method is part of income from continuing operations. Anyway, why do you have to memorize these things? Let me tell you why you have to memorize these things. If you turn back to page 128, and on page 128 is our classic example of a multiple-step income statement, except it's a statement of income and comprehensive income, because below the net income, below the net earnings, is other comprehensive income items. The reason why it is so important that you have to memorize what is other comprehensive income is because it is not part of net income. It's below net income. And net income is the performance measure that everybody tracks, okay, because net income is used in earnings per share, all right? And so it's not part of net income. It's other comprehensive income, and that's why it's so important. It's excluded from net income, okay? So you do have to memorize these examples of other comprehensive income items. Remember, they're shown net of tax effect. These are other comprehensive income items. They're not part of net income, but when you add net income and other comprehensive income, it becomes total comprehensive income, and that's the definition under standard number 130. Let's take a look at some multiple choice questions on this. I want to look at number 35, 40, and 41. 35, 40, and 41, they all involve comprehensive income. So let's take a look at number 35. Number 35 is found on page 147. Number 35 on page 147 says, which of the following is not an acceptable option of reporting other comprehensive income and its components? Remember, we have 3 approaches. On my handout for page 5, the approach is Present a second income statement, that's FASB preferred. Approach 2 is present a combined income statement. Approach 3 is to present a comprehensive income statement in the comprehensive income in the statement of changes in shareholders' equity. That's the prevalent one, which is to just bury it in a statement that no one else reads. One other thing, right below approach number 3, in some bold print, it starts regardless. I just want to read that to you. On my handout on page 5, about 3/4 of the way down the page, right underneath approach number 3, before the examples of other comprehensive income, it says, regardless of which approach you choose, approach 1, approach 2, approach 3, you must show the ending balance of accumulated other comprehensive income on the balance sheet after you retain earnings. So you show it on the balance sheet after you retain earnings. That's where it goes. Remember that other comprehensive income is close to accumulated other comprehensive income, a separate component of shareholders' equity that's shown after retained earnings. Let's take a look then at multiple choice number 35. Number 35 says, which of the following is not an acceptable option of reporting other comprehensive income and its components? Letter A, is it an acceptable option to do a separate statement of comprehensive income? Yes, it is. That would be approach number 1. Letter B says, in a statement of earnings and comprehensive income. That is an acceptable option. That would be approach number 1 on my handout. Letter C in the footnotes. That's it. That is not an acceptable option. Letter D says, in the statement of changes in shareholders' equity. That is an acceptable option. They want what is not an acceptable option. It is not acceptable to just bury it in the footnotes. So the best answer for number 35 is C. Let's take a look at multiple choice number 40, please. Number 40 is found on page 148. Number 40 says, what amount of comprehensive income should Searle Corporation report on its statement of income and comprehensive income? So they're doing the statement of income and comprehensive income, which is approach number 2, given the following net of tax figures that present changes during a period. Okay. Searle does not elect the fair value option for recording fair financial assets and financial liabilities. Okay. What amount of comprehensive income should Searle Corporation report in its statement of income and comprehensive income, giving the following net of tax figures that represent changes during the period? Okay, they have a pension liability adjustment recognized in other comprehensive income. So they have pensions. Remember, that's an other comprehensive income. So that's minus $3,000. That's already net of tax effect. Then they have unrealized gain on available for sale securities. Now, as long as they do not elect the fair value option under standard number 159, that's still considered to be an other comprehensive income item. So that's an unrealized gain on available for sale securities, which is $15,000. Then we have a reclassification adjustment on the securities included in net income. So basically, whatever they recognize an unrealized gain in a prior period on available for sale, we have to reverse that because now we're actually selling it this accounting period. So that is a reclassification adjustment of negative $2,500. Okay, that's another other comprehensive income item. Then stock warrants outstanding. Well, stock warrants are part of additional paid-in capital. We'll learn more about that in Module 11B when I discuss bonds. And then we have net income. Net income is over here. That's the $77,000. Okay. So they want to know what amount of comprehensive income should Searle Corporation report on its statement of income and comprehensive income? Given the following net of tax, figures that represent changes, okay, during the period. Okay, so basically what we have is we have the negative $3,000 pension item. We have the reclassification adjustment for negative $2,500, and then we have an unrealized holding gain on available for sale securities for which we have not elected the fair value option under standard 159. When you add up all those together, that gives you a positive $9,500. Take the $9,500, add it to the $77,000, that gives you $86,500 for your total comprehensive income, which is what they wanted. Now be careful, because on the exam they could ask for what is the total of other comprehensive income, in which case it would be $9,500. They could also ask you what is total comprehensive income, which is what they asked here, which is the $86,500. So the correct answer there would be A. You can choose A, but only if you're sure. Okay. Now let's take a look at another multiple choice question. That was number 40. Let's take a look at number 41. Number 41 is a doozy. 41 says, if negative $2,450 net of tax is a reclassification adjustment included in other comprehensive income in the year the securities are sold, what is the gain or loss that is included in income from continuing operations before income taxes? Now remember what we had in number 40. this is an unrealized gain, but this is reclassification adjustment. We had to do a reclassification adjustment because last year this was a positive 2,500. Last year this was a positive 2,500 because that was the unrealized gain. Then in this year we're actually selling it, so we have to reverse that. Next year, this positive 15,000, if we take that available for sale security and we sell it next year, this positive 15,000 will have to be reversed because then the realized gain will be shown in next year. Okay? So remember, this is reversal of a positive from last year. Now, what's going on in 41,000 is we're having this 2,450 that's like equivalent to this amount here. So if negative 2,450 net of tax is a reclassification adjustment included in other comprehensive income in the year the securities are sold, what is a gain or the loss would be a parentheses, that is included in income from continuing operations before income taxes? Assume a 30% tax rate. What's happened is that this 2,500 was positive last year. And the reason we're reversing it this year is because we're selling it as a realized gain. So what's going to happen then is you do have a gain. Okay, you do have a gain because it was gain last year. But remember, this is net of tax. Okay, the gain is shown before taxes. The gain is shown before taxes when it's realized. So the answer cannot be 2,450. So the answer is not going to be A, and it's not going to be C. So what's going to be the answer? It's going to be before taxes for the realized gain, and it's going to be a positive amount of 3,500. Remember, this was positive last year, all right, but it's backed out this year. All right, so, and it's positive then this year for the realized gain, but it's greater because this is shown net of tax and the gain is shown before tax. The realized gain is shown before tax. So the best answer for number 41 would be the 3,500. Now remember, that's net of tax effect, so the 3,500 is multiplied by 1 minus the 30%, so it's 3,500 times 70%. Okay, and that's how you got the 2,450. All right, so the best answer for number 41 would be letter D, like David, 3,500. Okay, let's see if we can go back to the notes then. I can't emphasize enough on page 132 again, you have to know this classified balance sheet. Okay, you've got to know the classified balance sheet. I just want to show you where the accumulated other comprehensive income item is shown. Once again, remember on my handout on page 5, at the bottom of page 5 of my handout, right above the examples of the other comprehensive income items, my handout says, regardless of which approach you choose, you must show the ending balance of the accumulated other comprehensive income on the balance sheet after retained earnings. If you take a look at page 132, which is our classified balance sheet, if you look at the far right-hand column, at the very bottom, under shareholders' equity, you have at the very, very bottom, you have retained earnings. Right below retained earnings, you have accumulated other comprehensive income. Then you have total shareholders' equity, and they subtract the treasury stock, which is a contra shareholders' equity account. So you see where accumulated other comprehensive income goes. It's right after retained earnings. Remember, other comprehensive income items are temporary. This is a temporary account. You close it into accumulated other comprehensive income. It appears after retained earnings net of tax effect on the balance sheet. Right there at the bottom, page 132, in the far right-hand side at the bottom. I just wanted to point that out to you. Remember, accounting is like spaghetti. Everything touches everything else. It's just the way it is. Okay. Oh, no. Now I have to go over, I wanted to talk to you a little bit about some different accounting standards. They do talk about standard number 157. Before I do that, we're going to talk about some disclosures. Okay. On page 133, about 2/3 of the way down the page, you see where it says on page 133 in your text, item number 6, it says other financial statement concepts. We are now going to have to look in the back of the book. Remember, don't go to the back of the book and look at the outlines until I tell you to go back to the back of the book. Okay, it's time to go to the back of the book now. We're going to discuss standard number 57. Standard number 57 has to do with related party disclosures, and that outline is on pages 972 to 973. So please turn to page 972. All right. Okay. Oh, sorry, I lied. 971. Page 971 to 972. How did I mess that up? I don't know. 971 to 972, probably because Cindy was asleep when I was writing this. 971 to 972. At the bottom, page 971, about 2/3 of the way down the page, on page 971, remember, don't go back here and look at the outlines until I tell you to look back here. We have specific disclosures All right, there's no debits, there's no credits, there's just disclosures that you have to put in the footnotes. Standard number 57 is related to related party disclosures. Now, if you look at the standard on page 971, and they say SFAS number 57, and they have R36. The R36 is a reference to our friend, the current text, which is organized in alphabetical order, like an encyclopedia. So where do you think you would find related party disclosures? Maybe under R for related parties. That's right. That's why it says section R36. That's a reference to the current text. Otherwise, you would just have to memorize that it's standard 57. That's just too much. Anyway. All right, so who are the related parties? Okay, let's take a look at the definitions. Here are all your related parties. First of all, you could have an affiliate. Affiliate is a party that's controlled by another enterprise that controls or is under common control with another enterprise directly or indirectly. That's sort of like if you own a company through the equity method of accounting. The equity method of accounting means you own greater than 20% of their outstanding shares so that you have significant influence over them. And APB 18 says that you have to use the equity method of accounting, and that's considered to be an affiliate when you account for them under the equity method of accounting. Remember, you own greater than 20% of the outstanding shares. Okay? Then control is when you own greater than 50% of the outstanding shares. Okay? Power to direct or cause direction of management through ownership contracts or other means. So basically, if you own greater than 50% of their outstanding shares, you have sort of like instead of an affiliate relationship, you now have a parent-subsidiary relationship, and you control them. Immediate family, like family members whom principal owners or management might control, influence, or be controlled, influenced by. So immediate family, fathers, mothers, sisters, daughters, sons, siblings, that type of thing, brothers and sisters. All right, number 4 does not include cousins, by the way. Number 4, management. Persons responsible for enterprise objectives who have policy-making and decision-making authority. For example, your board of directors, your chief executive officer, your operating officers, your vice presidents. These are part of upper management. Also, it includes people who don't have a formal title, so if they're acting in that particular capacity. Also, just the chief financial officer, okay, that's considered to be one of the management. The principal owners, these are owners who own more than 10% of the voting interest. If you own more than 10% of the outstanding shares, you're considered to be a principal owner. This also includes beneficial owners. So the related parties include any affiliates, the equity method investees, if you account for them under the equity method of accounting, which means you own 30% or more of the outstanding shares, employee benefit trust, principal owners, management, or any other party that can significantly influence a transaction. So those are related parties. Now, what do you have to disclose about the related parties? Letter B. The financial statements shall disclose material transactions between the related parties, except when, number 1, you don't have to disclose any compensation agreements, expense allowance, or other types of similar items as long as they're within the ordinary course of business. Now, if they're outside the ordinary course of business, meaning that they're excessive, so excessive bonuses, excessive compensation agreements, excessive travel expense accounts, and perquisites, then you would have to disclose that. So what's considered to be excessive, they'll tell you when it's excessive, or they'll say it's not in the ordinary course of business. If it's not excessive, then it would be within the ordinary course of business. What else you do not have to disclose? You don't have to disclose transactions which would be eliminated anyway. For example, sales and purchases between a parent and subsidiary, those would be eliminated, as well as receivables and payables between a parent and subsidiary. They would be eliminated in a consolidation, so you don't have to disclose that. Turn to page 972. Letter C says, the disclosures of the material transactions should include the nature of the relationship. Descriptions of the transactions includes any transactions which are assigned zero or nominal amounts. Number 3 says dollar amounts for the transactions for each income statement period and the effect of any change in method of establishing terms. Number 4, amounts due to or from related parties, including terms and matter of settlement. So these are receivables and payables. Letter D says representations concerning related party transactions shall not imply that they were equivalent to those resulting in arm's length bargaining unless such statement can be substantiated. So don't say that it was fair and arm's length unless it really was fair and arm's length. Okay. It's okay to transact between related parties. You just have to disclose it. And if it's considered to be fair, all right, don't say it's fair unless it is, okay? And then letter E says when a control relationship exists, that means that you own greater than 50% of the outstanding shares. Disclose the relationship even though no transactions have occurred. So, if there's a parent-subsidiary relationship, you still have to disclose it, even if there's no related party transactions. Okay, we are going to take a look at some multiple choice questions on the related parties. I want to take a look at least one. That will be multiple choice number 55, please. Number 55. Multiple choice 55 is found on page 149. Number 55 on page 149 says, what amount should be reported as a related party disclosure in the notes to Dean's 2008 consolidated financial statements? The Dean Company acquired 100% of the Maury Corporation prior to 2008. During 2008, the individual companies included in their financial statements the following. So they have salaries. Do you have to disclose the officers' salaries or the officers' expense accounts? No, you don't, as long as they are within the ordinary course of business. The only time you have to disclose them if they're outside the ordinary course of business is when they are excessive. They're not saying anything about being excessive here. So you don't have to disclose the salaries. You don't have to disclose the expenses. Do you have to disclose the loans to officers? Yes, you do. So the receivables and payables, right, between these related parties, you do have to disclose the 125 and the 50. Do you have to disclose the intercompany sales? No, you don't, because they would be eliminated anyway in the consolidation. Okay, so what amount should be reported as related party disclosures in the notes to Dean's 2008 consolidated financial statements? The answer would be the 125 and the 50. The total is 175,000. So the correct answer there would be C. Okay, let's go back to the notes. Back on the notes, on page 133, down towards the bottom, about 2/3 of the way down the page, 6B, accounting policies. This is your significant accounting policies. It's typically the initial first or second footnote, one of the first or second footnotes, right in the footnotes. Remember, the footnotes are an integral part of the financial statements. Disclosures are required of significant accounting policies. This is number 1, accounting principles whenever an alternative exists. This includes, you have to tell them what depreciation method you've selected, because you can use straight lines, some of the years digits, double declining balance, group or composite methods, whatever. Okay, units of activity or production. You have to disclose which method. Then you also have to disclose, for example, whether you use completed contract or percentage of completion method. If you happen to use the sales or cost recovery methods of installment method or a cost recovery method, all right, for installment sales. You have to also recognizing interest expense. You might use a straight line method or the effective interest method. You would disclose that. Also, for your inventory cost flows, whether it's FIFO, LIFO, or average method, you have to disclose which method you use there. So whenever there's, different alternatives exist within GAAP, you have to say, this is the one we use, okay? Then 2, you have to disclose any principles that are peculiar to a particular industry. In my current text, I keep holding them up. You don't have to buy these, okay? They do have specific industry standards for like oil and gas exploration. They also have specific industry standards for banking and thrifts. Okay, banking, they're not doing so great right these days. Also cable TV, that's industry specific. Computer software, okay, franchising. Oh, motion picture industry, that's always interesting. You'll have to be the accountant for the motion pictures. Okay, not-for-profit, oil and gas, blah, blah, blah. Okay, these are industry specific, so if there's anything particular to your industry, you would have to disclose, we use these specific types of practices. You have to disclose that in your significant accounting policies. All right, also item number 3, any unusual or innovative applications of accounting principles. Now, what they like to do is they like to trick you between, do you disclose this in the significant accounting policies, or do you disclose this as a separate footnote? For example, if you have property, plant, and equipment, you might say, we elect to use double declining balance method of depreciation. You would put that in your significant accounting policies. But then you would have another footnote that would tell you the historical cost, the accumulated depreciation, talk about the disposals of the equipment. That's a separate footnote on property, plant, and equipment. Okay? And they'll try and oftentimes confuse you with what goes in the significant accounting policies versus what goes in the separate footnote on PP&E. Okay, don't be confused. You just select the method and you tell them what method you selected in your significant accounting policies. All right, let's see if we can do some multiple choice questions on this. We're going to do 59, 60, and 61, please. 59, 60, and 61. 59 is found on pages 149 and 150. 59 says, on the bottom page 149, number 59 says, what is the purpose of information presented in the notes to the financial statements? Remember that the footnotes are an integral part of the financial statements. Let's start with letter D. Are the footnotes to present management's responses to auditor comments? No, you don't put that in the footnotes. How about letter C? Are the footnotes to provide recognition of amounts that were not included in the totals of the financial statements? No. If you included them in the totals, then you would have to expound on them. No, that's not the purpose of the footnotes. Is the purpose of the footnotes, letter B, to correct improper presentation in the financial statements? No. It should be properly presented in the footnotes. So what is the purpose of the footnotes? Take a look at answer A. Is the purpose of the footnotes to provide disclosures required by generally accepted accounting principles? Yes, that is the purpose of the footnotes. We just looked at a required disclosure that involved related party disclosures. Other disclosures are your significant accounting policies that are required under GAAP. Okay? They don't involve debits and credits. They're just additional disclosures. So the best answer for number 59 is A. You can choose A, but only if you're sure. Number 60 says, 60 is found on page 150. 60 says, which of the following information should be included in Malay Company's 2008 Summary of Significant Accounting Policies? Let's start down with letter D. Letter D, future common share dividends are expected to approximate 60% of earnings. Well, you probably disclose dividends in a separate footnote on dividends, not in the significant accounting policies. How about letter C? Business component 2008 sales are Alay 1 million, Belay 2 million, Soleil 3 million. Okay, that talks like that's about, they're talking there about segment information, and segment information we'll talk about in module 18C. That is a required disclosure, but it's not part of their significant accounting policies. It's a separate footnote called segment information. How about letter B? During 2008, the delay component was sold. Well, that would probably be in a separate footnote about their disposals or divestitures or discontinued operations, not in the significant accounting policies. How about letter A? Property, plant, and equipment is recorded at cost and depreciation is computed by the straight line method. That's it, because you're telling them which method that you use. So the best answer for number 60 is A. You can choose A, but only if you're sure. Okay? Number 61 says, 61. Which of the following information should be disclosed in the summary of significant accounting policies? Okay, should you disclose letter D, the adequacy of your pension plan assets relative to vested benefits? No, that would probably be in a separate disclosure on pensions. How about letter C, the criteria for determining which investments are treated as cash equivalents? That is actually the correct answer. That is the correct answer in accordance with standard number 89, which is a statement of cash flows. No, not 89, 95. Standard number 95, which is a statement of cash flows. You are required to disclose your definition, policy, and treatment for cash equivalents in your significant accounting policies. We will revisit that again when we do Module 15 and we discuss the statement of cash flows. All right, it's also in your handout. All right, I'll go over that again. Guarantees of indebtedness of others is considered to be a contingent liability. That would be a separate footnote that would not be in significant accounting policies. Letter A, if you happen to refinance debt subsequent to the balance sheet date, that would be considered to be a subsequent event. That would have its own separate footnote disclosure. It would not be part of your significant accounting policies. The best answer for number 61 is answer C. You do have to define the criteria for determining which investments are treated as cash equivalents. You have to say, this is my treatment for cash equivalents. All right, so that's it right there. 61, the best answer is C. We will revisit that again in Module 15 when we discuss the statement of cash flows. All right, then we begin on page 133. And what I want you to do is we're going to go over fair value measurements, okay? And let me tell you, fair value measurements probably applies to everything. And nothing has been more controversial than fair value measurements in 2008, and I'm sure it will be a continuing controversy in 2009. The reason that standard number 157, which is the topic fair value measurements at the bottom page 133, is so important is because I have here an excerpt from the Emergency Economic Stabilization Act. This was the $700 billion bailout that President Bush signed on October 3rd, 2008. And believe it or not, there are 2 sections of this bailout law that specifically mention this accounting standard. And I just want to read them to you because because the way they're written into the law, I really do not know what is going to happen with this standard. It's here, okay, for now. You learn it, but just keep in mind that things could change suddenly, and I'll tell you why, okay? Sections 132 and Sections 133 of Public Law 110-374, otherwise known as the Emergency Economic Stabilization Act of 2008, which was passed by President Bush on October 3rd of 2008, otherwise known also as the $700 billion bailout law, has specifically Section 132 and 133 that address this standard. And I'm going to read it to you. Section 132, authority to suspend mark-to-market accounting. They call it mark-to-market accounting because that was standard number 157 requires. The authority. The Securities Exchange Commission shall have the authority under the securities laws as terms defined in section blah, 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 blah of the Securities Exchange Act of 1934, blah, 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 to suspend by rule, regulation, or order the application of statement number 157 of the Financial Accounting Standards Board for any issuer as such term is defined in Section 38A of the Securities Exchange Act of 1934, or with respect to any class or category of transaction if the Commission determines it is necessary or appropriate in the public interest and is consistent with the protection of the investors. Savings provision. Nothing in subsection A shall be construed to restrict or limit any authority of the Securities Exchange Commission under securities laws as in effect in the date of enactment of this act. What does this mean? They are affirming, as we learned in Module 7A, that the Securities Exchange Commission has the legislative mandate to write generally accepted accounting principles in the United States. They write U.S. GAAP. Currently, they have delegated that to the private sector, which is the Financial Accounting Standards Board. But this act is just a reminder that says at any time the SEC can pull that standard and say, we're just not doing it. So I just want you to be aware that now I don't know if the SEC will choose to do this. Maybe they will, maybe they won't. They probably will not, but you just need to be aware that this law exists and at any time they can change it, in which case we will put that on our website. Okay, now here comes another one. It gets even worse. Section number 133. The SEC is now required to do a study on mark-to-market accounting. As we are filming this, the study is currently going on, okay, as we're filming this. I don't know what the results of the study is going to happen. They have to present the results of the study in January 2009 to the new Congress. Standard Section 133, study on mark-to-market accounting. Study. Section A, study. The Securities Exchange Commission, in consultation with the board and the secretary, shall conduct a study on mark-to-market accounting standards as provided in statement number 157 of the Financial Accounting Standards Board, as such standards are applicable to financial institutions. That's banks, okay, including depository institutions, because the banks had so much trouble. Such a study shall consider at a minimum, number 1, the effects of such accounting standards on a financial institution's balance sheet. Number 2, the impacts of such accounting on bank failures in 2008. Number 3, the impact of such standards on the quality of financial information available to investors. Number 4, the process used by the Financial Accounting Standards Board in developing accounting standards. Number 5, they're even questioning the way FASB develops their standards. Number 5, the advisability and feasibility of modifications to such standards. And number 6, alternative accounting standards to those provided in statement number 157. Report. Subsection B, report. The Securities Exchange Commission shall submit to Congress a report of such study before the end of the 90-day period beginning on the date of the enactment of this act. So sometime in January of 2009, the SEC is going to submit a report, okay, containing the findings and determinations of the Commission, including such administrative and legislative recommendations as the Commission determines as appropriate. So right now, the Commission is conducting the study. They'll have to report their findings in January. Folks, as far as I know, this is the only accounting standard that has ever been singled out like this in a law. That's how terribly controversial it was. I don't know what's going to happen with this law. All right, with standard number 157, for right now, we have to say, well, the standard is going forward, and we have to apply it. But at any time, remember, the SEC could pull it. They can pull it for anyone, for everyone, for just one particular class of transaction, for just one particular type of SEC registrant, such as bank or thrifts or whatever, some certain types of companies. I just want to let you know that this is what's happening. I follow all of this very closely, and the review follows it because we all follow it. If something happens, we will all let you know. So keep that in mind. That was written into the bailout law, the Emergency Economic Stabilization Act. Now that I've kind of excited you about that, now we're going to read the boring parts. Okay, so what are we supposed to know now about this rule? Okay, this rule has been very controversial. It was supposed to be first implemented on November 15th, 2007. On November 14th of 2007, they pulled half of it, and they say you only have to apply the standard to financial assets and financial liabilities, and they're delaying non-financial assets and non-financial liabilities, and they delayed it until November 15, 2008. Well, now here we are on the cusp, okay? And so standard number 157 is not going to be applicable to everything. So it's going to be it was applicable to financial assets and financial liabilities all during 2008, and then beginning in 2009, it's going to be applicable not only to financial assets and financial liabilities, but also to non-financial assets and non-financial liabilities. And that means property, plant, and equipment, all of that stuff. Okay, so it applies there now, beginning in 2009. But just remember, at any time, the SEC could decide to pull it. It was in that law, the Emergency Economic Stabilization Act. Okay, so let's read what's going on here at the bottom, page 133. In addition to reading this, I'm just going to tell you that there is a very nice discussion and outline of both standard number 157 and standard number 159. I'm going to read the text, but what I would like you to do is to go back to the original pronouncements in the back of the book. The outline of standard number 157 does begin on page 1017, and the outline of standard number 159 does begin on page 1019. I would just like you to review it. I'm not saying memorize it. I would just like you to review it because it is, it is an outline. It's organized in a nice little way. So I want you to read over on pages 1017. It begins on page 1017, standard number 157, and then on page 1019, standard number 159. Okay, so just read the outline. Of course, you never go back there and read those until I tell you to do, which I just told you to do it. Okay. I remember when they were writing this law, and it was just a bill, and I was extremely upset that they would even, basically they're just slapping FASB around. Well, the FASB, remember what we discussed in Module 7A. In Module 7A, before the FASB came who? The Accounting Principles Board. And before the Accounting Principles Board, the AICPA, Committee on Accounting Procedure, they wrote accounting research bulletins. All right? Then the Accounting Principles Board, they wrote opinions. And then we have the FASB that writes statements of financial accounting standards and interpretations. So who knows? They might be doing away with the FASB. As we're filming this right now, the SEC has put a proposal to go forward with international financial reporting standards beginning in 2011, I think. They're going to make that decision in 2011. So they're starting that process. So who knows what's going to happen to the FASB? Remember, there was two of them before the FASB that went away. Who knows what will happen to the FASB? And they're picking on the FASB in this law anyway. Let's take a look at the bottom page 133, fair value measures. Fair value measurements are required for certain assets and liabilities. I'm at the bottom, page 133, at the very bottom, letter C. Investments, derivatives, asset impairments, asset retirement obligations, goodwill, business combinations, trouble debt restructurings. Anytime they require a measure of fair market value, this standard 157, governs the way they calculate fair market value. They're not telling you when to use fair market value. They just tell you how to calculate the fair market value. Applying the fair value measurement approach involves the following 6 steps, so you can just read those 6 steps. All right, let's continue on. On page 134, I want you to see, all right, the first paragraph said that Standard 157 defines fair value as a price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. That means it emphasizes an exit price. It does not emphasize an entry price. It emphasizes an exit price. All right, the price that would be received to sell the asset or paid to transfer the liability. An orderly transaction is a transaction that allows for normal marketing activities that are usual and customary customary. In other words, it's not a forced transaction or sale. Fair market value measurement assumes that the asset or liability is sold or transferred in either the principal market or the most advantageous market. The principal market is a market in which the greatest volume and level of activity occurs. The most advantageous market maximizes the price received for the asset or minimizes the amount paid to transfer the liability. Market participants in the principal or most advantageous market should have the following characteristics. They should be independent, they should be knowledgeable, they should be able to transact, and they should be willing. That means they're motivated, but they're not compelled to transact. So this is part of the failure of the standard that we were seeing in the financial services industry, because people were feeling compelled, and they were like fire sale values. They weren't like really truly liquid markets, and that's what caused all our problems with writing these things down to fair value. Anyway, towards the bottom of page 134, fair value measurement, all right, I'm looking at the second to last paragraph at the bottom, page 134. Fair value measurement also assumes the highest and the best use of the asset. The highest and best use will maximize the value of the asset or group of assets. The use of the asset must be physically possible, legally permissible, and financially feasible at the measurement date. The highest and best use of the asset is then used to determine the valuation premise used to measure the fair value in use or in exchange. If the asset provides maximum value by using it with other assets as a group, it's considered to be an in-use asset. The in-use valuation premise is based on the price to sell the asset, assuming the asset is used with other assets in that group. If the asset provides maximum value on a standalone basis, the in-exchange valuation premise is used. The in-exchange valuation premise bases the fair value on the price that would be received in a current transaction to sell the asset standalone. Now, there's three ways